Hey there, welcome to the channel. So today I'm going to do a quick look at some of the sell-offs in the major averages over the last few decades. Okay, so today I didn't really feel like doing a video. So I just figured, because there really didn't seem to be very much going on. I know we had a little bit of a rally in the markets, but it's just down in the noise, quite honestly. So wasn't really impressed with anything. So let me start with the SPY. So what I've done here is I've gone back and I've looked at the SPY going all the way back to 95. And we can see that we had one heck of a bull market in the late 90s. And it led all the way to this peak in about 2000, March of 2000. And we had approximately like a 46% drop in the SPY. And that's what we had. Now, then we had another bull run going into 07, 08. And in this place over here, we had the financial crisis where, all the mortgages blew up and all that. And then we had a minus 55% correction. And then we've been pretty much in a bull run ever since. Now, we've had some periods where we had a minus 20% correction that was really quick here in 2018. And then also we had the Cerveza drop, which was very quick here. And then we're in the current kind of situation where we're coming off from our highs by 16%. So one of the things that I want to look at is if I was to go ahead and look and I would say like, okay, how much is the market going to pull back? If I go back to the last bear markets and try to say, hey, how much is it going to pull back before we can expect that we're going to put in a base and then start moving up again? Well, if I look at this for the SPY, I could see that like, okay, minus 46%, minus 55. And those are the only really two I can use. These are very short term, but these are like 20%, just a quick little 20%, quick little minus 32%, and we're at minus 16%. So if I was looking at this, what is the other factor going on? Well, one thing to note here, so going back to 2000, you can see the Fed interest rates were very high. They were at about 5.6%. And there was something else coming into that 2000, in that early part of 2000. They were cranking rates up again. They were cranking rates all the way to 6.4. So basically, when you look at it, they were sitting there cranking rates back up. And they get here to rates, about 6.4, 6.5%. The market holds and then the market starts going and then things just fall apart. And then they rapidly cut rates. Then they hold them at 1.6. So kind of see how they're stair stepping down and they get all the way down to about 1%. So what can we observe from this? First of all, we can observe that, yes, we had a quite a bull run. I mean, that's like going down like it was very low back in here. So, I mean, it's probably like an 80 or 100% run. And then we came off 50%. But one thing to note is that the Fed came in and tried to bail out the market. Once this thing started breaking, they rapidly took rates from 6.4 all the way down to 1%. And then they continued to take it down even further. Now, then they go through another rate raising cycle in the 2005 on. And once again, now they're flattening the rates at about 5.2%. And then all of a sudden the market starts having issues. And it's interesting right here because of the first little hiccups, there was already stuff going on before the market was fully responding and they're already dropping rates. And basically the conclusion is what? Once again, the Fed came in to bail out the market. So you had a 46% drop on the S&P minus 55%, and the Fed was bailing it out. Now, from an 09, it's important to note that we're down, the Fed rate was basically zero. All the way from this 09 to 2016, it's like 10 years of just like zero rates. So that's kind of incredible. So of course we get the stock market running. Now, here we go. The Fed comes in 2017 and they're kind of cranking rates up again to 2.4%. We get the tantrum here, it drops 20%. They immediately stop and they actually start lowering rates. And then we get the whole Cerveza thing in 20, and they take their rates. At that point, they were about 1.6%. They drop them all the way zero, essentially instantly. And what do we get? We get this huge run up in the market. And now the Fed is starting to crank rates and the market is responding. So there's a couple things that we can try to draw from this. First of all, the Fed cranking rates tends to have this negative effect on the market, even if it can be delayed, and it can be delayed by a year. You kind of see that it can take some time. Secondly, though, we see that even though the Fed may be late to respond, that they see, at least in all these cases back here, they've come back in and just dropped rates to zero to like try to do whatever they can to lubricate the market. That's what they've done. So it's a little bit different kind of situation right now. What's going on right now is you have the Fed is raising rates, and they are still talking about raising. They're at almost 1% right now, and they're talking about at least going another 1%. And at least two or three more 50 basis point rises. So, they're cranking rates right now. And you can see that, yeah, they're down here and they're trying to get to somewhere up in here, So the left is the interest rate. So they're trying to crank this thing back up to here. And we've already had the market kind of coming off. I mean, compare it to here, like the market. Yeah, the market over here didn't really start having trouble until they got their interest rates up to like 2.4%. Then they kept going and the market came off and then they dropped them, right? But here, the rates are only at like not even 1% yet. And we're already having all this massive trouble in the market. So that's one thing to keep in mind as well. In other words, if I was looking at this and said, well, what would be kind of an estimate where I'd really start looking around for deals and whatever, like 50%, somewhere in there, we should start finding a bottom. But that may not be the case this time, because that would have been the case if the Fed already had the rates up at 2 or 3%. And then they're like, oh, the market's starting to come down and they start cutting. But that's not what's happening. The Fed is actually in a rate raising cycle and they're just getting started. So this is very different from what was happening in 2000, very different from what was happening in 07. Remember, the market didn't implode. It was already several years. Interest rates were already high over here. Here for many years back in the 90s, rates are always around 5%. So, it's an entirely different situation. The rates are still down at like less than 1% right now. So that's something to keep in mind as well. Now we can look at the QQQs and look at the same kind of thing, really the same kind of thing that we see, here's the interest rates as well. And you see that, it was more volatile. So back in 2000, it was, minus 82%, minus 50%. And you know how it's kind of interesting how there's not a lot of financials in the Qs. So it wasn't hit as hard in the financial crisis over here. And then we have, minus 20, minus 30%. And we're at minus 30% right now. So once again, the question would be like, well, how much more do we expect this to go? One thought might be like, okay, 50%, or maybe it's going to be worse, 80%, something like that. All seems reasonably possible. The other thing to keep in mind, though, once again, the Fed has just started their rate rising cycle. And I assumed it's going to get short circuited. They're just starting and they're trying to get up, but I assume they're going to short circuit at some point. But they're already, once again, they're raising into a declining market, which is not, that did not happen here. That did not happen here. They weren't raising into a declining market, right? And now they're raising into a declining market. So it's a very different situation there. So I think that's what I kind of see for these, for these, what was happening here. And I think then the question, comes, what are we looking for? How do we know things are done? One of the problems is, one of the problems with trying to figure out when you're done is, from my perspective is, look, we got to just kind of, well, it's going to be interesting. It's really going to be interesting. Let me remove these moving averages here. So if I go back to the Qs in 2000, you can see that the market was going through the roof. I mean, this is an amazing run. Like right here, you're talking, it went from 55 to 100. It doubled in this very short period of time. And then it came off really hard. And then it kind of meandered around for a while before it really just started going into the selling. But the point is, at this point here, so basically what's interesting, the Fed has some technical analysis, right? As they break this low, as they're breaking that low, they're realizing like, oh, this is bad. And so they immediately start cutting rates. And there's a couple things that happen. I guess they cut rates down here and then they try to hold them and they're holding them and then they cut them again and then they cut them again. And I guess we get to the point where the Fed gets the rates so low that we're able to start putting in a kind of a base. And so, you wouldn't really, so it's kind of a problem. The first thing, so where is the bottom here? The bottom is you have a low, high, but look, you still put in a new low, lower high. Here's where you're starting to form a tiny little bottom. New low, you got a high, a lower low, but here's where it starts to change. Now, remember, this is on a weekly chart, but here's where it starts to change. You start putting in a higher high right here, right? Here you put in your first higher high. And then, yes, you come off a little bit here, but now you're actually putting in a higher low. So now you're starting to build up, and then it's very slow and slow and slow. But there's several things that happens. Then the Fed cuts rates again. And then at this point, they're at 1 and they're done. And now you started to see start basing out. Now, look, you're not in this super running bull market, but you're definitely in this huge basing pattern and you're finding your way out. So I guess if I look at that now, just speculation, first thing is you got to have enough selling to really get all the buyers out. So the selling is basically done. And this 80% move did that. The second thing is that this took 2 years from this peak here was like in March of 2000. This bottom, this absolute bottom was over 2 years, 2.5, 3 years later to get that absolute bottom. And that's important to understand. So every time you're in there and you're like, oh, this is the bottom and you're buying, and then you put in a new low, it's hurting you really bad. So that's why, especially if you're investing in stuff, then, really look at that weekly chart and look for it to start give you that inflection. Now, this is just the index, and the index, other indices and other stocks can do different things. The index didn't turn around here until there were other stocks for sure. So basically what's happening is this, but there were other stocks that were already turning in and putting their base and already going. And then you have more and more of them building up to bring the average up. So, certainly if you can find those stocks, and that's one thing I'm going to start looking for. So I'm going to start going through and trying to do that fundamental analysis and try to figure out like what companies are going to be left, so that when they get the crap kicked out of them, that they're actually worth it, like maybe buying in and stuff like that. So for example, like Vroom, even Carvana, Shift, those guys would just look, but the fundamentals just look horrible. Maybe they'll get better, but I don't even think they're going to make it. But and remember, Tesla is like very strong in a lot of ways, but remember, cars are cyclical, and Tesla has not outdone that. Cars are secular. When people are cyclical, blah. In a recession, people aren't going to be buying cars, and that includes Teslas. So they're going to go through a downturn too. Now, as long as they're strong enough, whatever, they'll come through that downturn, but they have to go through that as well. So that's kind of what we need to look for that big bottom. Now, if you're, just looking for a bottom in the Qs, then, this is what you're looking at. This is the kind of thing you're looking at, that, weekly chart turning around. And remember, the weekly is a very slow moving thing, so you're not getting whipsawed as much. However, if you're, looking at individual stocks, then look for those stocks to do it. Because like I said, there'll be leading stocks that will break out well before this. So I think that's it for this one. Talk to you later. Bye.